It is control. It determines which nations rise, which markets collapse, which wars are affordable, and which dreams are impossible. You use it every day, but you don't control it. This is Authority Anatomy, where we dissect the structure of power. Tonight, we examine the institution that shapes the global financial bloodstream. Not Congress, not Wall Street, the Federal Reserve. 1907, the United States faces financial collapse. Banks fail. Markets crash. Confidence evaporates. There is no central stabilizing authority. No lender of last resort. The panic exposes a vulnerability. The economy has grown too powerful to remain decentralized. In 1913, the Federal Reserve Act is signed. The Federal Reserve System is born. Official mission: stabilize prices, maximize employment, maintain financial stability. Unofficial reality: centralize monetary authority. The Federal Reserve does not print money in the way most imagine. It controls something more powerful: the cost of money, interest rates. By adjusting rates, the Fed influences borrowing, spending, investing, inflation. When rates are low, money flows, debt increases, markets expand. When rates rise, credit tightens, spending slows, markets contract. The lever is small. The consequences are massive. Modern money is not backed by gold. It is backed by trust and liquidity. Through open market operations, the Fed buys and sells government securities. When it buys bonds, it injects money into the system. When it sells, it removes liquidity. During crises, this expands dramatically. In 2008, the financial crisis. In 2020, the global pandemic. Trillions of dollars were introduced into the economy, not printed in vaults, but created digitally. Balance sheets expand, assets inflate. The system stabilizes temporarily, but every intervention reshapes economic gravity. The Federal Reserve is described as independent. It is not directly controlled by the president, not voted on by the public. Its leaders are appointed, not elected. This independence is intentional. Monetary policy requires insulation from short-term political pressure. But independence also creates distance. When inflation rises, when housing becomes unaffordable, when asset bubbles form, the public feels the consequences. Yet the decision-making process remains technical, data-driven. The Fed does not campaign. It calibrates. 2008 financial crises expand central bank authority. Major banks face collapse. The Federal Reserve intervenes aggressively. Liquidity programs, emergency lending facilities, quantitative easing. The system survives, but power consolidates. In 2020, history repeats. Markets freeze. The Fed moves faster, larger, more aggressively. Balance sheets reach unprecedented levels. Each crisis reinforces a pattern. Instability increases dependence. Dependence increases authority. Authority becomes structural. The Federal Reserve influences more than the United States. The US dollar is the world's reserve currency. Global trade is priced in dollars. Oil transactions settle in dollars. International debt is issued in dollars. When the Fed adjusts interest rates, emerging markets feel the shockwaves. Currencies weaken. Capital flows reverse. Debt burdens increase. A domestic policy decision becomes a global event. The architecture of money extends beyond borders. When money supply expands rapidly, asset prices rise. Stocks surge. Real estate appreciates. Wealth increases, on paper. But inflation follows. Purchasing power declines. The same system that stimulates growth can erode stability. The Federal Reserve walks a narrow line. Stimulate too much, inflation accelerates. Tighten too aggressively, recession follows. Precision is required, but perfection is impossible. The Federal Reserve does not control your paycheck, but it influences its value. It does not set your rent, but it shapes mortgage rates. It does not dictate markets, but it defines liquidity. Money feels personal, but its architecture is institutional, invisible, strategic, systemic. The Federal Reserve is not a villain, nor is it neutral. It is a mechanism of centralized monetary authority. And in a world built on debt, liquidity, and trust, the mechanism matters. Because when money shifts, power shifts. This has been Authority Anatomy, dissecting the structure of power.